Hi, and welcome back again to Tim Bigham's Big Time Options, Edges and Hedges, taking a look at why IV really matters. In this case, a follow-up to our SanDisk trade from a few weeks back, where a 10% stock drop combined with a big drop in IV leads to a 100% gain in just a couple of weeks. So let's jump in and take a look, shall we? We always like to focus, as we say, on that fusion approach, combining fundamental, technical, and most importantly, in this case, IV analysis. So for those of you who are subscribers, you got the trade from a couple weeks ago, right? Here's the actual trade, why IV matters, right, on SanDisk, why it was an opportune time to short long-term IV, went out as far in time as we could go, December of 2028, right, to take advantage of IV that we didn't think would stay that elevated, right, proved to be prescient. You certainly can watch it on my YouTube channel here, follow that link. It's telling a long-term strangle to capture the highest IV level ever in SanDisk and why that paid off. So here was a scanner. We're not going to go in depth. You can watch that original video from a couple weeks ago. SanDisk showed up on the unusual option activity list, right? You can see valuations, as we said, had gotten to extremes, but starting to soften, still at ridiculous levels. We thought proved to be prescient here. As you can see, post earnings, the price to sales ratio moved from almost 15 to under 9 right on Friday, and this is just in a couple weeks. From July 20th, right, the PE before earnings was 47-ish, now only 16 as earnings beat, but the stock got tomahawk chopped, so valuations now looking somewhat attractive. We very well may do a bullish trade on SanDisk here shortly, and we always like to take a look at the technicals as well. Here on a technical basis, you can see the stock briefly traded, right, on July 29th below that $1,000 level that has held, for a long time here as far as support. So we'll probably use that in a future trade, maybe as our short put strike, right? But you can see technically the stock getting pretty much back to neutral, right? 9-day RSI at 40 briefly got oversold here, was overbought earlier, right? MACD about as neutral as it gets. Same with Bollinger percent B. But most importantly, you see what happened to IV. We actually hit it almost on the head here. July 20th was the trade date, right? Selling that IV, we expected to collapse. It certainly did. And speaking of IV, we always like to take a look at that. That's our most important component of our trade process. So here was before the trade, right? You can see IV on the long end, right? 120-day IV at the highest level ever, had jumped, right, from the 17th or 16th to the 17th, jumping higher. IV at 100%. IV at 100% on another measure here, right? You can see our December 2028 2340 straddle, which was one of the trades we looked at, had moved higher from July 2nd to the current date, right? Moving up, even in that time frame. Here's a look at that 360-day IV, absolutely exploding to the highest level we've ever seen. So we're looking for this to revert, right? Looking for the stock, which is overvalued, maybe to run into a little bit of trouble on that front. So we are examining a couple trades. Here's the straddle that we first took a look at, right? But we found one even more interesting. So we took a look from May 15th, the stock at 1382, the 2340 straddle that expired December of 2028, trading at just under $2,100. Fast forward to July 17th, 18th area, right? That 2340 straddle actually ripped higher, right, by well over 150 points, right? Even with the stock virtually going nowhere, the stock dropped a little bit, but that straddle exploded. Why? Because of this huge uptick in implied volatility. Your upside and downside break even certainly gave you plenty of cushion on the trade. You can take a look at the original video for more in-depth dive. We actually like going out and selling the 2200 put and 3000. We actually end up selling the 3100 call, right, for about the same price the 2340 strangle was trading at 2 months prior, with the stock virtually at the same price, right? So because of that huge run up in IV, we could get a bigger downside and a much bigger upside cushion on the trade, which we took advantage of. So here's the actual trade we did, right, which was selling the 2200 put and the 3100 call for a 2057 net credit, right? About 44 deltas net short, even with the stock at 1400 roughly, right? The put 800 points in the money, right? The call 1700 points out of the money. It's still a bearish trade. Why? Because IV is so high at over 113. So we're looking for the IV to revert and looking for that red hot rally to cool, right? The buying power effect or the margin requirement on the trade to sell a 2200 call or 2200 put in 3000 call, $2,800, $361, right? So let's fast forward to Friday's close, and we can see what happened with IV. It reverted as expected, right? Here's the original date of the trade, right? In July 20th time frame, right? You can see IV at the highest level, as we said, ever, right? You can see what happened. That reversion took place in a big way from July 20th to last Friday, right? You can see that even from Thursday to Friday, IV got tomahawk chopped in a big way, right? Here's the previous on Thursday. Here's Friday's close, right? And you can see IV, which had shot up so strongly, right? Moving up 50% from June the 18th to July the 17th when we put on the trade, right? You can see from that day, July 17th to now, August 7th, IV has absolutely reverted back, actually lower than where it started. The at-the-money IV now below the average of over the past 3 months, which is up here. So IV certainly getting cheap, electing to take the trade off. You can see that that 100% IV rank is now only 20% on this metric from Thinkorswim. That 100% has moved to 12%. So IV certainly has come down sharply. Here's that comparative on the 2340 strike, moving from basically July 24th, right, which was just after the trade, to Friday's close, how big a drop that was. And from Thursday to Friday, you can see a 4% drop. Taking a look in a different perspective, here was the date we put the original trade on IV at this extreme. You can see what happened. We absolutely hit it, got lucky and hit it exactly on the head. The nice thing about IV, you don't have to be exact on it, just in the ballpark will work. This one we actually proved to be prescient, right? Plus we had plenty of time, right? As we said, we could hedge with shorter term puts or calls if needed. But this one, the huge reversion in IV, as we anticipated, set up ideally to close out the trade. So the P&L on the trade, taking a look at it here. Here is the original trade, right, as we said, selling the 2200 put, right, and then the 2200 put dropping in price big time, right? The 3000 or 3100 call in our case also shooting up and dropping back in a big way. So able to cover our strangle, right, for under 1800, right? We sold it for over 2050, so realizing a 284 point gain or over 28,000 gain on one contract, right? So over that time frame from July 20th, the date we put the trade on, the stock at 1354.82. August 7th, the stock did drop. We are not short, so we certainly benefited from Delta, but not in that degree. It was more of an IV capture, right? The stock dropped over 140 points, but the strangle dropped more than double what the stock did because of this IV crush of huge magnitude, almost 15 IV points. And with the stock dropping 142 points, the short put actually went down in price 43 points. The call, as expected with the stock drop, went down, but it went down at almost twice the pace of the stock drop. So this IV crush that you can identify sets up ideally, right, for that vol capture trade, leaning a little bit bearishly, but that's a lot because of the high IV, right? So our net gain on the trade, as we said, 28,400 on one contract. The margin needed basically about the same 28,361 as we saw back here, right? Which leads to 100% return on the money tied up, all mostly because of this IV drop. Yeah, we picked up a little bit of theta. The nice thing about that huge jump in IV, your theta, your time decay you capture is even greater, right? The higher the price of the option, the higher the theta, right? And we are leaning, as we said, a little bit bearishly as well. But most importantly, we're able to identify that huge reversion in IV. That's what we look to identify day in and day out here at big time options. So the ability to, in essence, make 100% return on a 10% or so move in the stock over less than a 2-week time frame on super long-term options. The fact you're trading options that don't expire until December of 2028, so you have a couple plus years to go on this trade, doesn't mean you have to hold on to them until even close to then. We are able to get in and get out, take advantage of that huge IV reversion, have a very safe trade with a ton of cushion, right? As we said, the cushion on the trade was massive, right? You have just huge upside break even and downside break even. The upside break even basically over 5,000 on our trade. The downside 153 because we were able to sell that strangle, right, for very close to the short put strike, and that call strike price of 3,100, right, we're able to bring in over 2,000, so we have plenty of upside cushion as well. So a low risk trade, to say the least, that makes 100% on a 10% move in the stock in 18 days. I think makes a lot of sense, all because we're able to identify ridiculous IV pops. A lot of this had to do, I believe, with Leopold Aschenbrenner, or Leo Asperger as I'm terming him, right, with that huge reversion in IV from that just unbelievable level, right, into lower. Some of our other trades we've talked about on similar stocks, right, similar in nature, all worked out similarly well. So hopefully provide some insight how we go about identifying trade opportunities here at big time options, position size accordingly, give ourselves plenty of cushion, right, the ability to hedge, the ability to take advantage of implied volatility analysis to find the edge and put on the hedge. But we always say day in and day out, right, trading is all about probability, not certainty, right? So you want to make sure you position size accordingly, right, and make sure you get out when it's time to get out, or re-hedge when it's time to re-hedge. But sometimes you just got to say what the and go for it, right? And in this case, it's set up ideally for a taking advantage of ridiculous IV. We knew it would end badly. We didn't really think this quickly, right? But it did end badly for IV especially. So hopefully provides insight how we go about finding and identifying trades here at Big Time Options. So until next time, as always, here's the good trading. Take care.